Hi, my name is Loic Lemenner, founder of Opus Wealth Management. I created this video because the markets, as of today, June 3rd, 2026, seem to be going straight up. And there is a long list of worries that we need to think about before we get overly optimistic about where especially the US equity markets will go from here. So I just wanted to deliver some sobering facts about some big risks out there to balance the narrative that we're seeing in the news every day. So my first point is just the sheer size of the US equity markets today. They're hovering around $73 trillion in a $32 trillion economy. That makes them over twice as big as the current size of the US economy. If you're forecasting a 10% return from here, then the stock market would have to grow to 189 trillion over the next 10 years. Now that's certainly possible, but it's completely off the scale with what we have seen in developed countries historically. That would be by far the greatest stock market bubble in all of developed world history. So if you're forecasting a relatively humble 10% return from here, you really need to have an incredibly optimistic base assumption in terms of your ending point in 10 years. The second point, and I won't belabor this because I always show this to my clients, but valuations are pretty much at all-time highs. So the black line, the dark black line here, is the average expensiveness of the stock market going back to 1900. We had the 1929 bubble followed by the Depression. We had a nice recovery after World War II, leading up to the Nifty 50 in 1966. Then the Nifty 50 bubble collapsed, and then we got inflation, which sent valuations to near all-time lows. And then we got inflation under control, the tech bubble of 2000, that popped. And then we had the real estate bubble, which levitated stocks for another few years, although the primary bubble was in real estate. And then when the real estate bubble popped, then we got back to average valuations. And then we had 10 years of 0% interest rates and a Fed regime of money printing. So that now we are left at, today, close to all-time highs. And so not much good has happened from here when you look at history. I would mention just one data point, which is we have good stock market data for 24 countries going back to 1900, 24 developed countries. You have never not gone back to average after a stock market bubble. So that would imply a 60% drop on the S&P 500 from here. Just because it's happened every time in history doesn't mean it's a 100% chance of happening going forward. But obviously, if it's happened every single time in 3,000 years of history, you have to assume that there is a fairly high likelihood that that happens again. Okay, let's talk about AI a little bit because that is really what is driving the narrative these days. Earnings have been very good, but they have been very good almost solely from the tech sector. So the tech sector is really driving up the earnings for the S&P 500. And there's an accounting quirk here that is really important to understand, which is if I'm Google and I spend $1 billion on chips at NVIDIA, NVIDIA, just the way accounting works, recognizes that $1 billion sale in the year that I'm in. Google is gonna capitalize that expense, meaning they're not gonna flow it through their income statement. They are gonna first put it in what's called construction in progress because they're building a data center that could last a year or two. And then they're gonna say, okay, well, my data center is gonna last, pick a number, 6, 7, 8 years. So they are going to depreciate that expense over a much longer period of time. Ramps up, that creates a disconnect between the revenues of the suppliers and the expenses of what we call the hyperscalers. So a lot of this earnings growth that we have seen recently is purely due to this effect. The next point I want to make is there are increasing warnings from people that really understand market structure on the effect of passive investing in the US. So passive investing in the US, i.e. investing in index funds, used to be a trivial amount of the market. And especially once 401ks started defaulting to those options, a very, very high proportion of 401ks today, of the flows into 401ks, go into what are target date funds. Target date funds are mostly index funds. So from the time an employee is hired for a job, they are defaulted in their 401k in a target date fund. That money flows to an index provider like a Vanguard. There is literally not an ounce of thought given in that whole daisy chain of events. So as long as passive is increasing and there are more flows and there are increasing flows going into the market, that effect dominates the stock market because there's a price insensitive buyer. Now, Mike Green, who's probably the world's foremost expert on this, estimates that we are at 55%, the US stock market is 55% passive, and that if we get to between 65 and 80%, it is a mathematical certainty in his words. I don't understand the math well enough for me to convey that to you as a certainty, but certainly there is a possibility of a discontinuity in the markets. What that means is at some point there's just so much buying and so few sellers that either the market could spike up for a period of time, or if you had the reverse happen, which was, baby boomers are starting to have to take minimum required distributions, or we get a bout of unemployment where passive flows go in the other direction, you could have a bunch of people wanting to sell at the same time with no buyers. It just creates this juggernaut of not very thoughtful, in some cases, zero thought money that is sloshing the market around and could be very dangerous over the next 5 years. Next, what I'd like to do is talk about the war, because I do feel a little bit like it's February of 2020 when COVID was just starting to spread and epidemiologists throughout the world were talking about it like it was a disaster and Wall Street didn't pay attention at all. Today, the commodities people, the oil analysts, etc., are telling us that we're heading for a disaster, that by the time summer comes around, July, August, that we are going to have shortages in the Western world, and nobody seems to care. So I put up some statistics here on what we depend, how much commodities flow through the Strait of Hormuz. Obviously, oil is the big one, but there's a lot of secondary commodities as well that are really important to the global economy. This is a very complicated geopolitical confrontation. There are many parties involved, and it's not like Trump can just taco and go home. The Iranians need to willingly give up control of the strait for one reason or another. That could be paying a toll, which nobody seems to have the tolerance for, etc. So everybody has been thinking this would be a short-term thing. So far, it has lasted. It's gone from weeks to months. Does it go from months to years? If it does, then we have a serious problem in terms of these commodities that we need to run the global economy. Okay, this is another kind of more long-term worry, which is the idea, there's something in economics called the Kalecki equation that just says all the profits in an economy can only go one of four places. It can go to companies in the form of profits, to households in the form of savings, to the government in the form of savings, and then to foreign players. So when you think of the pie of the economy, every dollar of value that is created in that economy has to go to one of those four places. And if one of those buckets is doing much better, disproportionately well, then the other buckets have to suffer. And what's happened, especially since 2000, is that corporate profits have skyrocketed relative to normal. When you look at the other buckets, which is namely the US government and households, the US government is not only not saving, it is obviously running a massive deficit. As of the last 12 months, it was around $1.7 trillion, and we're not even in a recession. And then US households are saving, but they're saving at some of the lowest rates that they've ever saved in US history, right? So when the US government and households are not capturing wealth, then it's going to other places. And the main place it's going to, yes, we have made China a much wealthier country over the last 20 years, and that's one of the buckets that it goes to. But profit margins in the US today are abnormally high. So you need to think about that when you're thinking about, what you're willing to pay for a company, especially if it's a massive cyclical company that's going to be affected by the economy, is how long exactly can we run these kinds of deficits? Now, that is probably one of the trickiest things to forecast in all of economics, is at what point does confidence in a government break? We had what they called the Liz Truss moment in England a few years ago, where bonds just cratered when Liz Truss, the new prime minister, put out a budget that was a lot of spending and not much taxes. And so, we could have a moment like that tomorrow, and this could be not a big deal for 10 years. But this is a stimulus effect on the stock market that cannot go on forever. Okay, something else that has pumped up the US stock market is what they call the yen carry trade. All the yen carry trade is very simple. It's sophisticated players in the economy borrowing in yen because interest rates were so low, and then going to buy US assets and a lot of US risk assets, including stocks, right? So if you can borrow at 0.5%, and then you can go invest in the US stock market, that can be a great way to make a lot of money. The problem with that is that if interest rates start going back up, then your funding costs get more and more expensive. Or if you're less optimistic about US stocks. So maybe instead of borrowing at 1 or 2%, you're borrowing at 4 or 5%, but your prognostic for the US stock market is more humble. That could lead you to unwinding this. Lately, we have seen the interest rates in Japan start to meaningfully increase in a way that we haven't for 20 or 30 years. And that has caused some market participants to worry that this trade is going to unwind. How big is this? The truth is, estimates are all over the place. I found this report from Bloomberg that was updated for 2024, where they estimated the size of the yen carry trade was $3.2 trillion. So very meaningful. That's the international investments in the U.S. stock market total are about 20 trillion. So there's always the risk that foreigners don't want to invest in our capital markets and repatriate money. The thing that makes the yen carry trade even more risky is because it's fueled by debt. And so should interest rates keep rising in Japan, it seems logical there's a breaking point where people don't want to put on that trade, and you would have arguably 3 trillion or so of US equities to unwind as people want to pay back those debts. Okay, now we're going to talk about AI again. Sorry, I didn't put this in a great order, but when I think of AI, I wonder what the good case scenario is. And what I mean by that is we are spending hundreds of billions and trillions and in the low single digit trillions of dollars building out AI CapEx, which is of course fueling some economic activity. We have no idea what the returns on those investments are. I think anybody that tells you with a straight face they know what the return on AI spend is really either trying to sell you something or doesn't have the humility they should have. But I think of what is a good case and a bad case scenario for AI, and I'm not sure what a great case for AI is, because AI is a technology that, on the optimistic scenario of the technology working well, i.e. lots of agents doing a lot of work, as well as low-level employees, then you're going to have massive unemployment. If it doesn't work that great, then you're going to have really cruddy returns on all this capital that we've spent. So I don't really understand. I feel like AI optimists, from an economic perspective, I can understand some people being optimistic in terms of productivity, but in terms of how it's going to support our economy over the next 10 or 15 years, I feel like they're trying to thread a needle perfectly, where AI is productive enough to make us much more productive, but not so productive that it causes layoffs. I think that's a pretty small target to hit. Okay, let's continue with a point I want to make about supply and demand. So a lot of people know that one of the forces that has pushed the stock market up is buybacks. So companies are using an incredible amount of their free cash flow to buy back their own stock. What this chart is showing you is as the AI capex has increased significantly for the hyperscalers, their ability to buy back stock has gone down. So much so that some of these companies have zero or negative free cash flow due to their AI investments. So what was a major source of demand for stocks has been significantly decreased. On the flip side, you have several IPOs that are trying to be priced right now. So just to put things in perspective, in the late 90s, between 1996 and 2000, 2,300 companies raised about $500 billion in today dollars, in inflation adjusted dollars. Today, 4 companies, Google just did an $80 billion offering, and then SpaceX, OpenAI, and Anthropic, those 3 companies are looking to go public, and combined, those 4 alone are looking to raise about $280 billion. So again, the supply dynamic is shifting from a long bull market of buybacks to now supply coming online to finance the AI race. We have a problem with AI, however, which is the spending far outstrips the revenue of the industry. So it's really important to understand that at the end of the day, an industry is dependent on the end user revenue. So what's the product that everybody is paying for? And for AI, it's subscriptions. It's things like, subscription to OpenAI or subscription to Claude. That revenue of the end user revenue is very generously about $100 billion, as best as I can figure. I've looked for a bunch of numbers online, and that's, I would say, very generously the upper end of the estimates that I have found. The problem, again, is that by the end of 2026, is we will have spent over $2 trillion on AI capex. So just if you want to break even, you're going to have the industry go up about 20-fold from here. And yes, AI will grow at 30, 40, 50% a year, but is that quick enough, especially if they spend like they plan to in 2027, 2028, so that by the end of 2028, we'll have spent more than $3 trillion. What's the ultimate return on investment on all this spending? Jeremy Grantham, one of my heroes, made the point on a recent podcast that the returns on capital for an economy have been remarkably stable over the last 200 years. And so will this then increase productivity? Absolutely. But will it increase productivity more than productivity had increased thanks to the internet, thanks to electricity, thanks to planes and trains and all the major technological innovations we've had over the last, especially 100 years? That really remains to be seen. Nobody knows. This was kind of a shocking statistic that I saw recently, which was how much money we've printed since the beginning of 2025. So, COVID, yes, we printed a lot of money, and that's at least somewhat understandable in that we had a major crisis. But 2025, from 2025 to today, especially pre-war, there was really nothing much going on in the world in terms of crises. And yet the central banks of the world saw it fit to print the equivalent of about $17 trillion. And so this was shocking to me. This is one of those things that when you think of the only 2 forces that carry a bigger stick than governments are the bond vigilantes, the bond market, tanking bonds and interest rates increasing, and inflation. And if we had to print $17 trillion just to maintain this momentum we've had in the markets, that is a very worrying sign to me. I did want to end this presentation with a warning to disciplined investors. This is a chart of a prototypical bubble. And what you find is, usually the smart money is wherever the next fad or technology is going to be. There's always a group of people that are just sitting there because that's their field, right? And then as that technology becomes more known, then early sophisticated investors that are tracking this stuff get in, and then late in the bubble, everybody's getting in. And James Montier at GMO called this the final kick in the nuts for disciplined investors, because at some point you kind of raise your hand and see these parabolic moves where seemingly it's just easy money being made. The typical example was the NASDAQ in 99 was up something like 80% in the same year where Berkshire was down 50%. There was nothing wrong with Berkshire, but people just wanted to take money out of something that was, a cash flow machine with slower growth to put it in pets.com. Now, never mind that it only took something like 18 months for Berkshire to get back to even with the NASDAQ, because the NASDAQ cratered after March of 2000. And so, there's an old saying with bubbles: you can look like a fool before they pop, or you can look like a fool after they pop. And obviously in our practice, we've chosen to look like fools before they pop. But thankfully, at least so far, our value investments have not dragged as much as they did in the late 90s, although they could over the next couple, 2-3 years, however long it takes for this bubble to pop. So I just wanted to make this presentation as a counterbalance to what a lot of people are seeing in the news. There are some big bad things out there that should give you pause and warrant caution. And that is it. So thank you for your time and attention, and I'll talk to you soon.